The bullish kicker pattern is a 2-candle pattern that is a bullish indication, and I know this is a favourite among some technical stock traders. The first candle should be a long down candle or black Marwood, while the second candle should be a long up candle or white Marwood. The second candle must open above the prior candle's open, and the second candle low must be higher than the prior candle's high. In other words, a gap needs to be formed. According to most sources, the bullish kicker is most powerful near areas of support or during a downward trend. Unfortunately, I've found that this is actually quite a rare signal in futures and forex and even liquid stocks because of the gap, and also because it requires two very strong candles with hardly any upper or lower shadow. In fact, the ideal bullish kicker is made up of a black Marwood and then a white Marwood with no wick. And then when you combine that with a gap, that makes this pattern very rare. Nevertheless, the bullish kicker is powerful when it does occur because it shows one side of the market, the bulls, are taking over. Here's an example in WBA. The stock opens on a gap up and that strength continues over the next few days. Using the formula for the bullish kicker pattern, we can scan and backtest the database to see what happens when trading the signal. The first table shows the results from buying a bullish kicker pattern on the close and then holding the trade for one full day. As you can see from the results, this is actually a very rare pattern because of the gap and because it requires two opposing candles that have very little shadow. In fact, in 14 of our chosen markets, there was no bullish kicker pattern over the last 16 years. And this is a big problem because it means we can't draw many conclusions from these results because of the small sample size. So perhaps the bullish kicker is better suited to shorter time frames like intraday charts, or maybe it should only be used for less liquid securities. Either way, you can see from these results that the bullish kicker is not worth looking for on liquid forex pairs, but it did okay in stocks, albeit with a very low sample size. For example, buying a bullish kicker and holding it for 3 days produced an average gain of 0.79% across S&P 100 stocks, with a healthy win rate of 60%. Holding for 5 days produced an average gain of 0.91% per trade, with an even higher win rate of 66%, while holding for 10 days produced an average gain of 0.44% per trade, and this was on a sample size of 220 trades. Even though there were relatively few trades, these are good results which may require some further research. As I said, it might be worth testing this pattern on smaller cap companies. It might also be worth loosening the formula to get more signals, and I do this later on in the course when I introduce another pattern called the loose kicker.